And now I'm happy to turn it over to my colleague and partner, Matt Weiner, to lead the discussion on the use of transaction liability insurance in distressed transactions.
Great, Gary. I have the presentation up here. Let me make sure that it is up and running.
I see it.
Perfect. Well, thanks everyone for joining us today. The purpose of our panel is to have a discussion on the application of transaction insurance and its use in the M&A space. My name is Matthew Weiner. I'm one of the national practice leaders for Aon's transaction liability team. And prior to joining Aon, I was a corporate attorney at Vincent & Elkins for 5 years. I'll let the other two panelists introduce themselves, starting with Gary Blitz, and then we will jump right into the materials.
So hi, everyone. I'm Gary Blitz. I lead Aon's global tax insurance practice and co-head our overall M&A and transaction solutions practice. I'm on the panel to talk about tax insurance and how it can be used in distressed transactions. I'm a former tax lawyer, practiced for 20 years, and came over to Aon about 17 years ago, and have been involved really from the beginning of turning this interesting concept into a business.
Hey, good afternoon, everybody. My name is Chaim Thiel. I am counsel in Paul Weiss's M&A department. First of all, I'd like to say welcome to everybody. It's nice to see some familiar names in the participant list. My practice focuses on private equity and strategic M&A. Say about 75% of my practice is focused on restructuring transactions, 363 sales, and other distressed investing transactions. And I'll be talking today, along with Gary and Matt, about some of the legal implications and negotiating implications of a rep and warranty insurance policy.
Thanks, Chaim. So as we mentioned earlier, the purpose of this panel is to really get into the weeds on how transaction insurance is being used to improve deal outcomes and enhance returns in distressed transactions amongst buyers, sellers, and creditors. We're going to talk about a couple of different topics, including the use of reps and warranties insurance, the use of tax insurance, and the use of very specialized policies such as contingent liability and litigation insurance. So to start, we're going to have a discussion on the use of representations and warranties insurance for distressed transactions. So for the investors out there who haven't utilized reps and warranties insurance, this is a product solution that effectively insures a buyer against the types of losses that it would incur as a result of the representations and warranties that a seller makes in a purchase agreement being untrue. And so the idea behind a reps and warranties insurance policy is to take the risks that are traditionally negotiated between the buyers and sellers and perhaps the creditors, and to effectively transfer those out of the transaction and place them on the balance sheet of a third-party insurance carrier to really allow for the parties to effectuate a cleaner transaction that results in a better outcome for all the parties involved. When we think about what the reps and warranties insurance is designed to do, there's a couple of unique applications, particularly with respect to distressed M&A. And so we're going to be talking about distressed M&A in the context of both outside of a bankruptcy setting and in a formal bankruptcy setting, such as a 363 process. So when we think about particularly the application of it outside of of a bankruptcy process, in a distressed transaction, you may have a creditor who's forcing a seller to sell certain businesses or assets. And typically speaking, in that type of transaction structure, most, if not all, of the proceeds that are paid by the buyer will flow through to the creditor. And so as such, you will see that these transactions are oftentimes structured as what's called an as-is, where-is deal, meaning that the seller is making very limited representations and warranties, if any, and the buyer is really effectively taking the assets on an as-is, where-is basis. And so because of this construct, we have found that it, in some cases, can lead to the inability of certain prospective buyers to participate in these auction processes, meaning that because it's not a true bankruptcy process where perhaps a free and clear order would be obtained, the buyer is effectively opening itself up to certain liabilities, and without the option to seek recourse against a seller, it precludes certain buyers from being able to participate in that process. So over recent years, certainly as we saw distressed transactions in the energy space, we started to see sellers implementing a construct in their purchase agreement that contemplates the use of a reps and warranties insurance policy. And by doing so, it enables that seller to make the ordinary course representations and warranties that it would typically make in a non-distressed transaction, but the transaction is structured much like a public style deal where there is no post-closing recourse to the seller. So even though the seller is making those representations and warranties, they effectively terminate at closing. And this allows the buyer to then have a reps and warranties insurance policy that effectively replaces what would look like a seller indemnity. So the buyer is now able to look to that insurance policy to provide it for recourse for any losses that it sustains. And by implementing this structure, what we typically see is that it has increased the competition or the number of buyers that can potentially participate in a process. And it also typically can result in a larger return of capital to the creditors because for transactions that are structured on an as-is, whereas basis, buyers are often going to discount the purchase price they pay for the perceived liabilities that they're going to inherit as a result of that structure. Whereas with the ability to have an insurance policy to effectively reimburse it for those types of exposures, it oftentimes can allow for them to submit a higher bid, which again will result in more proceeds flowing through to the seller.
Yeah, and Matt, if I could just jump in for 1 second,
Absolutely.
just to add what you said to what you said. As Matt mentioned, I think there are really 3 buckets of transactions in which this product is useful, which Matt went through. One is, an out-of-court restructuring, 363 or plan asset sale, or more rare, an equity 363 or plan sale. And in addition to the scenario that Matt just laid out, obviously in a lot of out-of-court restructurings, you have lenders who convert their debt into equity. And obviously, these lenders obviously understand the business. They've done some diligence on the business. They might not have necessarily been up to date on the operations of the business through the period in which the transaction is going to be consummated. And so if there are particular areas of heightened risk that a lender taking equity wants to protect against, this is a great product to do so. Most of the out-of-court restructuring agreements I see, come with operational reps, limited survival, if any, of indemnification, similar to what Matt was just alluding to in an out-of-court sale. And so, folks don't really think about insurance as protection in that scenario, largely because the negotiation is so quick and always comes down to the wire. But this is certainly a product that can help reduce the risk to a lender that is taking equity in an out-of-court transaction.
Yeah, Hein, that's very helpful. And I think, as we transition into this next slide, where we're going to discuss protection for buyers from breaches, the application of this within a 363 process or a process whereby a free and clear order would be obtained, we've also found some interesting applications. So, Hein, can you talk to us about kind of what a free and clear order does and doesn't do?
Sure. In a 363 transaction and in a plan transaction, the court will issue in its sale order or confirmation order an order that the assets or the equity, we'll talk about equity in a second, that the assets are being acquired free and clear of pre-petition liabilities. And that essentially wipes out 99% of your liabilities that would typically travel with your assets. which is why you see this product being used less in 363 asset sales than you do in other scenarios. But there are certain categories of liabilities that either cannot be discharged by law or are actually assumed explicitly in your contract by the purchaser. So some examples, and we'll talk a little bit more about this later. In particular, when you hear about environmental liabilities and you hear about labor or employment liabilities, those are really the two areas that you need to watch out for. Under law, certain environmental liabilities, particularly reclamation liabilities, if you're talking about coal transactions, there were a lot of those a couple of years ago. Those are the types of liabilities that transfer over with the assets, notwithstanding a free and clear order. Certain labor and pension liabilities cannot be discharged in bankruptcy. I think that's probably a little bit harder to insure against than the environmental risks, but there's certainly a conversation to be had with providing coverage for those risks. And then, as you see here in the presentation, you're not getting a free and clear order for breaches of reps respecting the condition of the assets that you're buying, or with respect to the financial statements that you're on which you're purchasing the assets. Most taxes are dischargeable in bankruptcy. There are certain taxes that are not. Sales taxes are one of them. We just did a transaction in which there was a big issue with the California sales tax that we actually were able to insure for. And then intellectual property, which is always, whether it's a restructuring transaction or just your typical M&A transaction, there are always issues around transferring intellectual property and liabilities with respect to particularly third-party licenses and contracts. So while it would seem like a 363 sale or a planned sale means you can walk away free and clear, those are the areas which require heightened scrutiny and which you should speak to your legal advisors about.
Yeah, I think what's interesting is it's the type of assets or types of businesses that are being sold in 363 processes. The category in which those assets fall, I think, lends to whether or not a insurance policy makes sense. Certainly in the energy space, we've seen a lot of transactions where the majority of the value is being ascribed to physical assets. And so, the idea that you're coming up with your valuation based on what you perceive the value of those assets to be is important. And the concern a lot of our clients have is, well, if we close on this transaction and we discover that the assets were not in a condition that was fit for their intended purpose, and we're required, day one after closing to put in significant capital to bringing those assets up to working order that we didn't believe to be the case and that the seller didn't represent to, that can be a material exposure. So it will certainly depend on the type of business or assets being acquired. But we've certainly seen the utility there in the context of a 363 sell. The other point here, and this I guess would probably be more useful outside of the context of bankruptcy, but just the ability for a buyer to have a creditworthy counterparty for which to seek indemnity, obviously can be very important. Even in distressed transactions where perhaps some of the proceeds are going through to the seller, you'll oftentimes see parties trying to negotiate an indemnity from that seller, typically in the form of escrow, but sometimes contractual in nature. And so one of the areas that our clients oftentimes have concern in a distressed transaction is, do we feel like we can actually recover from this seller? Even if they're putting money into escrow, are we going to spend, years in dispute resolution trying to recover in the event we need to make a claim? So one of the abilities that an insurance policy has is to effectively insure that risk with an A-rated insurance carrier who's in the business of paying valid claims. And that can also provide significant value to buyers in distressed transactions. So Chaim, why don't we kind of walk the investors through, in the event they're looking to actually place a policy, what should they expect from a process and timing standpoint?
So in my experience, insurers can move and underwriters can move pretty quickly. And obviously, the earlier that you're able to identify risks in your transaction, the better, especially if you're in a heated auction process. Obviously, in court restructurings, the timelines are very condensed. There's a lot of pressure on the business to emerge as quickly as possible. But generally, as you'll see in the slide, going from start to finish on a policy would take about 2 weeks. I've seen it done in less time. I would encourage you to, and this is not a plug that Matt and Gary asked me to make, but I would encourage you to build a relationship with a broker and an underwriter. And the reason I'm saying that is because, in these scenarios in which you need to move extremely quickly, you want to be sure that you have a team you're comfortable working with. The process is, if you haven't done it before, it's not that straightforward. I'd say most lawyers, have dealt with rep and warranty insurance. Not all of them are adept at negotiating the policies, et cetera. So I would encourage everybody to, look at who the market leaders are. Obviously, Aon is one of them. Build a relationship so that in the event there is a condensed timeline, you're able to move quickly and you have a team that understands your needs and is able to move quickly as well. So, the first step is obviously to reach out to your preferred broker. I mean, the leaders that come to mind are Aon and Marsh. In my mind, I only use Aon. Most people at Paul Weiss actually use Aon too, but Marsh is another one that I think has a strong presence in the market. And let's just use Aon as an example. So Aon will go out to the market and get indications of interest from underwriters based on your draft purchase agreement, the financial statements of the business, if there's a management presentation. What you'll get back is a summary of indications from various underwriters. Oftentimes, or most of the time, the broker will narrow down the choices for you, and which will help you select an insurer. And I would encourage folks to not look for, and this is true in most things, but don't necessarily take the lowest price product. You want to make sure that you have an underwriter, an insurance company that's very creditworthy. Most of the insurers that are out there, most of the underwriters are very strong. I think there are some that are a little bit stronger than others, AIG, Chubb, and the like. It will sort of lay out how so this summary will lay out how the underwriters and the insurers are thinking about this risk, what the proposed policy price is, what the exclusions are, if any, what your deductible is, et cetera. Once you choose an insurer, they're going to ask you for typically a written summary of whatever diligence has been performed. And this gets a little bit tricky, right? If you're on a timeline that doesn't allow you to do, as much diligence as you would like, again, that's why I was saying earlier, it's very important to identify the risks early on and think ahead about getting these insurance products because of the back end work that's required to actually get these policies. So you'd submit a diligence memo or an internal memo that was prepared, outlining the work that third-party advisors, bankers, or consultants have done or lawyers have done on this particular risk. Once that's done, you'll get a draft policy from the underwriter. These are pretty standardized at this point. There are a couple of points that are really fundamental around fraud that, and subrogation that, are typically heavily negotiated. Once the policy is negotiated or alongside that, you'll keep the broker and the underwriter informed as to the process to make sure that you're aligned. And you typically like to conditionally bind your coverage at the signing of your transaction, not at the closing. And so you pay, right? As a buyer, you want to know that you're signing the transaction knowing where your risk will be allocated. A little later, we'll talk about, some difficulties that could arise at a signing, but typically you'd want to put down a 10% deposit on the policy, have the policy provisionally bound at signing, and then finally bound when you get to the closing.
Yeah, just a couple of points I want to add to that, because I think it's important for the investors to know what the underwriters are expecting. So simply because a seller is willing to make a representation in your purchase agreement doesn't necessarily guarantee that the insurer will be willing to insure that risk. So as Chaim pointed out, I think the most important consideration is to identify those particular liabilities that are most important to you, and to confirm that you're able to do some form of due diligence around those particular risks. The way the insurers are getting comfortable with underwriting these liabilities and insuring them is they're looking to the buyer or the insured party to really kind of walk the insurer through how that buyer has gotten comfortable with those associated liabilities. So when they're looking at a representation in the purchase agreement that says from the seller, the assets are, in good and working order and are in a condition fit for their intended purpose, they're going to ask the investor, how are you comfortable that representation is true? And the investor or buyer needs to be able to say something more fulsome than simply, well, we asked the seller to make the rep and they agreed to do so. They would expect that the buyer has perhaps done a site visit to review those assets, or has looked at historic CapEx or maintenance logs to confirm that the type of repair work that would be expected or type of ongoing maintenance work was done in the ordinary course. And so if you think about those particular liabilities, environmental, for example, were phase ones conducted? Does the target have a history of environmental compliance? These are things that the insurer will be looking for the buyer to confirm that it's done. But assuming that the level of diligence done is what we would consider to be ordinary course, our expectation is that for the most part, insurers are willing to virtually underwrite most liabilities that you would find in a purchase agreement. The other point I want to raise too is on transaction size. Gary can certainly speak to this as well, but we have seen the scope of or size of transactions that are insurable really expand dramatically on both ends. So, where we sit today, I would say that we can underwrite and insure transactions probably as small as $10 to $20 million in enterprise value. And on the opposite end of the spectrum, really no cap. We've worked on transactions with enterprise values well into the billions of dollars. And so effectively, there's really no capacity constraints on the ability to underwrite a transaction on the basis of size. I think as a general matter, the key consideration is the smallest insurance policy you can place is typically going to be somewhere between $3 to $5 million of coverage. So for an extremely small transaction, that's likely going to be considered overinsurance, and the cost-benefit analysis may not necessarily make sense on that transaction.
Yeah, it's not that we can't go smaller. It's just the costs start getting skewed, and you'll pay the same thing for that $1 million policy as you would for a $3 million policy.
That's exactly right. The last thing I want to mention before we go through just a few case studies is just on the claim side and what to expect in the event you obtain a policy, you close on the transaction, and lo and behold, 6 months later, you discover there's a breach of a representation that's resulted in loss. I like to describe it as it's going to be very similar to the process that you would have pursued a seller for indemnification. But you're now working with what's essentially a third party who's neutral and who is in the business of paying a valid claim. So we actually have litigators on staff within the Aon platform that work with our clients to actually get these claims processed. And it's generally a process whereby you're confirming to the insurer that there has in fact been a breach of a representation. That's usually the easier part of the exercise. And then the second part is trying to quantify what the loss is. For certain representations and warranties, that may be straightforward. For others, where perhaps you're making a claim for breach of a financial statement representation and you're seeking some type of multiplied damage, it may be a bit more complicated. But as a general matter, I would say that claims are typically getting reimbursed within 1 to 12 months, depending on the complexity. And we have found that virtually all the insurers in this space have been very commercial in working with our clients to get those valid claims paid out.
Yep. Matt, before you go on, I think we didn't mention this, but there's a Q&A function, I understand, on the platform. And so if there are any questions You could submit your questions to the Q&A, and we'll try to answer them towards the end of the presentation.
Thank you. So we're going to go through just a couple of quick case studies. I want Chaim to spend some more time on his, because I think it's actually a lot more interesting than the first two, but the first two are pretty straightforward. So, in the first transaction that we have referenced here, it's actually one that I worked on, and it involved an energy-focused private equity fund who was going to acquire an oil field service business from another private equity fund. This was not within the context of a true bankruptcy proceeding. But virtually all of the proceeds from that transaction were going to flow through to the creditor. And so primarily on the basis of concerns around condition of assets, the buyer wanted to place a reps and warranties insurance policy. So in that transaction, we were able to get the seller agree to make what would look like very ordinary course representations and warranties. The buyer undertook what would be looked at or reviewed as ordinary course due diligence. And as a result of that, we were able to place a policy that fully insured the buyer against breaches from those representations and warranties. That policy had what I'll call normalized terms for a reps and warranties insurance policy. So these policies generally provide coverage for 3 years for breaches of general reps and warranties. For the non-lawyers on the call or on the presentation, those are the representations that speak to typically the historic operations of the business. And then the policy also provided coverage for 6 years for fundamental representations and warranties and for tax representations and warranties. The second transaction reference was one that was done within the context of a 363 process. We were representing a pre-stalking horse bidder who was looking to acquire certain infrastructure midstream energy assets and had concerns around some of the things Chaim mentioned earlier, including tax, environmental, and condition of asset liabilities. So similar to the prior case study, it was a transaction where even though it was within a 363 process, we were able to get the seller to provide full sale representations and warranties. Much like a public style deal, those terminated at closing. But again, it now allowed the buyer to have a policy that was going to fully reimburse it or indemnify it in the event those representations and warranties turned out to be false. I'm now going to turn over to Chaim to talk about
Hey, Matt, Matt, before you go on, just
Sure.
one point that just may not be obvious. I know it's one we take for granted, that there's no recourse to the seller. If there's a claim, the insurers are taking this risk. It's not just a credit enhancement; it's actually risk transfer.
Yeah, just to finish that point, the insurance carriers within these policies typically include carve-outs for under what scenarios they could potentially pursue a seller. And as a general matter, it's almost always limited to fraud. So absent fraud, there really is no recourse to a seller in a transaction that uses reps and warranties insurance. And again, it is a risk transfer tool to shift that risk to the insurance policy. So Chaim, talk to us about the interesting Chapter 11 sale that you worked on.
Sure. What I'll say is, just to be clear, everything I say is already public. And so I just want to make that point up front. I'll do this on a no names basis though. We represented a consortium of private equity funds that were looking to purchase assets from a company in the oil and gas industry that was looking for a stalking horse 363 buyer. It was a long sought after asset. There were private equity firms years before looking to buy that piece of the business. It wasn't for sale. Finally, the parent company filed for bankruptcy, and they sat there with this very valuable asset that the parent and the creditors wanted to sell as part of the overall bankruptcy. And the transaction came down to a handful of bidders. Obviously, as would be typical for a company side purchase agreement that's served up in an auction, this was structured as a 363 asset sale, no liability to the company, which is what you would expect, no indemnification, really public style. And our clients were trying to find a way to distinguish themselves in the process. Obviously, price is always something that matters, but this is an auction, and so you could always get outbid. And so what we came up with was proposing to do this transaction. And I'm not suggesting that this be done for every business. A lot of diligence needs to be done in order to do this. But that goes back to the point of preparing your diligence for these transactions. They decided to propose this transaction as a stock deal in a 363, which is not very common. Right? Purchasing the equity in a 363 sale means that the buyer will obtain the equity of the companies that are being purchased free and clear, but the assets and liabilities of those entities come over wholesale as if you bought those entities in your typical private equity transaction, notwithstanding the free and clear order. And the reason that this was a good strategy was because, if you're talking about a multi-billion-dollar asset, especially one that is CapEx heavy, equipment heavy, transferring and retitling assets from 50 entities into the name of a purchaser is a very, very time-consuming process. You have to transfer bank accounts. You have to transfer title to assets. You have to transfer employees. You have to set up new 401k plans. You have to set up new benefit plans. That can take a long time. And if you're a seller in a restructuring transaction, obviously you and the creditors want to close as quickly as possible. And so by proposing an equity deal and insuring for the risks under our purchase agreement with a rep and warranty policy, which was a fairly large policy and needed to be stacked with a number of underwriters, our client was able to become the stalking horse bidder as part of the process. Obviously, there were other factors that went into it, but proposing a deal which would minimize the disruption to the business, minimize management's requirements for transferring assets, right? It's much easier to just transfer equity, really helped them in the process and was part of giving them a leg up in winning the auction process. As I mentioned, this was a carve-out transaction, which creates its own difficulties. Luckily, this business was siloed, so the entities which housed this business were pretty separate from the rest of the business. There were a couple of assets that needed to be transferred in pre-closing, but for the most part, it was siloed. But the difficult part about the transaction were the carve-out financial statements. The publicly filed financial statements of the business, this was a public company, had consolidated financial statements as you would expect, but there was no specific carve-out financials for this business. And so one of the most important parts of the process was preparing carve-out financial statements. Unfortunately, that takes a very, very long time. And when we got to signing of the transaction, there were still open questions on the viability of the carve-out financials. There needed to be some additional diligence done. And so what we did was we worked with the underwriter to provisionally bind the policy at signing, but we had a note or qualification in our policy that said, if between signing and closing, the purchaser is able to complete its diligence on the carve-out financials, and we're able to get the underwriter comfortable, the underwriter would remove the exclusions which were included with respect to the carve-out financials. So, there's a small part of the business that was international that wasn't, diligenced that heavily. What the insurers basically told you was, we'll insure all of your reps, will insure you on the carve-out financials. There are exclusions on the areas in which you did not do, were not able to complete the diligence in time. However, we'll give you the policy between signing and closing, bring the diligence down to a level in which the underwriters were comfortable. And obviously you want to know what that's going to look like before you sign, and we'll remove the exclusion. And I'm happy to say that the exclusions were removed at closing, which is why it's very important to go with an underwriter that has a good track record, and you can rely on when they say they'll remove something after consideration in good faith, they'll actually do it. And so we were able to not only give our client a leg up in the negotiating, they were also able to effectively insure the carve-out financials, which covered 99% of their exposure in the transaction.
Thanks, Chaim. So before we jump over to Gary, we got two questions that came in that I'll address before we move on. So the first question is, what about companies with less than ideal books and ordinary course due diligence may be difficult? Can underwriters make those situations work? The answer is yes. As a general matter, most of these insurance carriers are staffed by former M&A attorneys as well, and they'll generally work with the client to try to get to the right place. That being said, the due diligence exercise still needs to be there. So, in Chaim's example, he mentioned a transaction where the diligence wasn't able to be completed at signing. And so we can still put policies in place if there are material subject matters that the buyer hasn't had a chance to perform due diligence on. We can include qualifying language that allows the buyer to complete that post-signing, and even in some cases post-closing, in order to have coverage for those matters thereafter. So as a general matter, what's important is in that pre-underwriting phase is to make it clear to your broker and the insurer what will or won't be able to be provided during underwriting, and to understand exactly what the expectation will be around coverage before you make a determination as to whether or not to move forward with putting a policy in place. Second question is, what are the typical exclusions that the policies carry, and is fraud or fraudulent misrepresentation excluded? So what I will say is, as a general matter, the policies are intended to reimburse or insure the buyer against unknown liabilities. So to that end, if in your due diligence as a buyer you uncover known issues, those are generally going to be carved out. Anything that's disclosed on the disclosure schedules, while also being an exception to the rep, will be deemed to be a known issue, also would be carved out. And then there are certain things which Gary will discuss in the tax space, such as deferred tax attributes, that they're also carved out. Other than those matters, certain industries, such as environmental coverage, can sometimes be challenging if it's a business that's historically had a lot of exposure to contamination or pollution. But as a general guidepost, I would say that insurers are generally amenable to underwriting most of the material subject matters in the policy. The last question around fraud, no issues for a buyer getting coverage even if a representation was fraudulent. There's no carve out for that. As I mentioned earlier, the insurer will have a subrogation right and could potentially pursue the seller if fraud is deemed to be the reason that the representation is untrue, but it will not preclude the buyer from making a claim. So that's a good segue as we move over to Gary. As we mentioned, the reps and warranties insurance policy is intended to cover unknown issues, but oftentimes in diligence, known issues arise. And we're going to cover now what can be insured with respect to known issues, starting with tax.
Thanks, Matt. And before I jump into tax, I just wanted to go back to one point that was mentioned earlier. Having to do with conditional exclusion and wanting to make sure there's a good underwriter at the table who's going to stick with it and underwrite through that even after a policy is bound. But another aspect of that is you want to make sure you have a broker like an Aon that has some market clout. We put in a lot of premium to the industry, and a misbehaving underwriter has ramifications well beyond the one deal you're working on. So just another aspect, a little more on, how practically some of these things operate. As Matt said, tax insurance, is something. It was really the last question was a perfect segue because there is some tax insurance, tax coverage in the rep and warranty policy, but that's more that the ordinary course tax reps are true, and may pick up something like sales tax exposure, But once something is identified in the diligence or on the schedules as an exception to the rep, you need to pivot away from rep and warranty insurance to tax insurance. And the way I think of tax insurance, and like this slide says, is it's the insurance version of a private letter ruling. So it's a way of getting certainty as to a tax outcome. The insurance policy will specify the intended tax treatment, whatever that is. For example, one of the case studies we'll talk about a little bit more is that net operating loss carryforwards are good and will have navigated the 382 limitations and other requirements for a buyer to take them over. If the IRS or a state and local government or a foreign country's tax authority comes in and successfully challenges that tax position, the insurers then will pay the tax, the interest and penalties, the costs of defending the position, and a gross up for tax on the insurance proceeds. And in many jurisdictions in the United States, Western Europe, the insurance proceeds of a tax policy are viewed as taxable. And so, we see it coming up. It could become covering risks, of different types. It may be transfer tax risk, or it may be something just noted from the structure of a transaction. This slide just shows some representative tax issues which may come up in a distressed deal. That interest deductions will be respected, net operating loss carryforwards. When there's restructurings of debt, issues such as cancellation of indebtedness income comes up, worthless stock deductions, reorganizations and recaps, the treatment of intercompany transactions, and benefit plans issues. We often see a real disagreement between buyers and sellers counsel, often because diligence and on fast timelines can be limited on whether and benefit plans that have been around for a long time, will be treated the way that's expected. And then, outside of the distressed area, things that we see, all the time, the tax treatment of acquisitions from founders, S corps, reorganizations being either tax-free or not more taxable than the parties intend, spin-offs. We insure a lot of real estate sales that qualify as REITs, that those will be respected as tax-free. On and on and on. Transfer pricing, partnership issues, and we also do quite a lot in the tax credit space, ensuring transactions that have relied on federal and state tax credits to ensure renewable energy, to finance renewable energy, affordable housing, historic rehabs. And just to complete the thought, we also, kind of the third piece of the puzzle is just tax policies that are used where there isn't a transaction, just to add certainty. But it's a very broad scale. Matt, please flip this slide. Almost anything in the tax spectrum can be insured, provided the insurers can get comfortable, and it gets down to their diligence. What's interesting with that is the tax insurers are all staffed with tax lawyers, and they really have the capability of diligencing these issues on their own. We typically want to bring them some work product because it's a much more efficient process if they're reviewing someone else's work rather than creating it. But they have the ability to go very broad and often they can take a more aggressive view than you might see in written tax work product prepared by a lawyer, because they don't have, the insurer can get comfortable any way they want. If there's a tax statute with no case law, no regulations, but they believe something's being handled in line with the intent of that statute, they might write that policy, even though a lawyer couldn't write a very strong opinion because there's just not authority out there. What's off the table are aggressive tax shelters listed in reportable transactions, transactions of interest that the IRS has identified as illegal. And the insurers don't write policies just based on we won't get caught on the audit lottery. They will diligence the risk and have to be comfortable that the position taken is defensible. Tax they do not believe is owed. And then Matt had mentioned earlier our capability of doing small as well as very large has expanded in both directions. Here we say the minimum exposure is $5 to $10 million. And keep in mind, that would be tax plus potential interest and penalties and a gross up, not just the amount of tax. And we can go smaller and do sometimes. It just skews the cost. On the high side, we've done transactions with north of $1.5 billion of insurance limit and can go probably as high as $2 billion if we get all the insurers involved. Tax reserves, this is more of an accounting thing. We saw companies and clients really accounting for tax insurance in different ways when there was a tax reserve. So we got some advice from one of the big four, and we really were guided that if there is a tax reserve and it's good, and it's one of those things that's good enough to be insured, not all tax reserves will be, and we wrap that tax policy around the reserved issue, it'll have two impacts. One will be it'll neutralize the financial statement impact of the reserve because there'll be corresponding entries, and it'll be a positive to the P&L because you're in a sense reversing the expense taken when the reserve was put up. Next slide.
And so, Gary, I know we're running short on time here. We've got a couple of case studies, and you've mentioned a few, but perhaps maybe talk about one or two of these, and then we'll move into the final portion of the slides.
Sure. So I think this first one, let me just skip this first one and go to the next two. The first one was about bad debt deductions. The second one is interesting. It was a situation where there was a bankruptcy, and the outcome, of the bankruptcy was a sale of the company involved. I think it was a 363 sale. And the sale was really promoted by the former CEO. And he had an employment contract and was to receive a large payment when the deal happened. The estate agreed to indemnify him against golden parachute excise taxes. They had a legal analysis that essentially backed out of the base for the tax, that the value of a non-solicitation agreement. But what was interesting is the way the deal was struck with the bankruptcy plan was there was going to be an escrow account put up to back that indemnity, and that cash was going to sit out there for possibly, 6 or 7 years and maybe longer if the IRS looked at it. And that money was not going to get to the creditors until that was positively resolved. So we were able to use tax insurance to insure the estate that tax liability wouldn't accrue. And that allowed for the release of cash to the creditors, much more than the cost of the insurance. So it's just a great example of how, when there is a tax liability assumed by the estate, often the traditional answer was a cash escrow. And by insuring it, you're adding liquidity and letting that cash be released to presumably creditors.
And I think, Gary, just to make a quick point, I think this is a very important point, which is insurance is essentially, it not only protects a buyer, but it can be used as a value gap and a value bridge. Management, directors obviously have heightened risk in restructurings, given all the parties and the fiduciary duty shifts, et cetera. And so insurance is such a great way to shift and to gap a value bridge, which you'll see all the time, and it's something that you can propose to a seller if the seller is not thinking about it.
Yeah, absolutely. And the way we often think about it is the policy itself will protect the buyer, but often the dynamic is it's allowing the seller to do less. And so the benefit of the insurance is often for the seller.
Right. And that's true for everything, tax and all other liabilities, right? This is not just tax, this is everything.
Warranty insurance, same dynamic. Absolutely.
Yep.
And the final case study is just a situation where a buyer was, the deal was able to be constructed that the buyer retained the right to use net operating loss carry forwards, which is often very complex. It's complex that the NOLs exist to begin with, and then it's complex that limitations such as the 382 limitations in the tax code, which haircut losses to limit how much a buyer can actually use them. It's difficult to get comfortable. A lot of legal time goes into it. And when you have a transaction that value is actually being paid based on that tax attribute, a buyer wants more protection often than just accounting work product or a legal opinion. And tax insurance, we insure NOLs all the time, and this is just a great way to add certainty to that outcome. Again, same theme, without requiring a seller or an estate to escrow money that has to sit out there for 6 or 8 or 10 years.
And so just to build on that, I know we only have 1 or 2 minutes here, but the other known issues that oftentimes come up in the context of an M&A transaction are litigation risk. And so one of the interesting products that we've seen develop over the last couple of years is the ability to insure pending or threatened litigation or to put in judgment insurance. So, if the target has won a lawsuit and is concerned about appeal, there are markets that are willing to underwrite the outcome of either ongoing litigation or to preserve the judgment that was in favor of the buyer. And then the other area that we see in the distress space is, certain contingent liabilities. One of those is fraudulent conveyance, probably more likely to be outside of the bankruptcy context. But in the event that a buyer, is acquiring a business and is concerned about third-party creditors or minority shareholders asserting a constructive fraud claim, a policy can be put in place for that buyer, effectively insuring it against any losses that would result from a successful fraudulent conveyance claim. And then additionally would be successor liability claims. And maybe, Chaim, just to wrap things up, maybe just kind of quickly touch upon what successor liability means in the context of a distressed transaction. I think you're actually on mute.
This is similar to what we were talking about before. Even if you think you're getting a free and clear order, and this comes with pension liabilities are a big one here, just by virtue of the fact that you're a successor to the business, the liability could travel. Same thing with, and I think that's the example here, same thing with certain types of product liabilities. You cannot discharge in bankruptcy and will travel with the assets, whether you like it or not, as a successor to the business. So this coverage would help bridge that gap.
Great. Well, that's the end of the presentation. I think we maybe have 1 or 2 minutes here. Are there any questions from anyone in the audience that we haven't addressed? All right. Well, it looks like we don't have any other questions. So I don't know if Robert or Michael is next, but we will turn it over to you as soon as you're ready.